All right. Good morning, everybody. So it's here. It's that day. We have CPI, and every month there are potentially 3 days where we have this trade opportunity, the potential for it, anyways. I call it a liquidity gap. I've seen it called other things. We'll get into what it looks like in a little bit, but the main thing is it's got a very distinctive setup. So it's either there for a trade or it's not. And that's really nice. Looking at what's going on around the world, small caps are closest to zero. They're a little bit above it, actually. And then we've got the S&P, the Dow, and when we get far enough away, we got the NASDAQ, but still they're at a basically zero level. Everything is just holding its breath, waiting for these numbers to come in. Nothing else on the table today for the week, for the month, has more impact than the CPI other than maybe FOMC. And if that surprises you, consider we already know what the Fed is going to say, right? Higher for longer. They're not going to cut. They're not going to raise rates. They're just going to stay where they are. So it's not a surprise. They've telegraphed that fairly well. So somebody could argue CPI is a bigger unknown than the FOMC. There is always the possibility that they come out and raise rates, right? That is always possible. And it's being priced in a negligible amount, right? About less than a 10% chance that it's going to happen. But what you don't see is them cutting rates. There's not even a hint or a possibility or a 1% suggestion that they might cut because there's no cuts. No cuts. So what are they going to say that we don't already know? The FOMC's like, it's like a foregone conclusion at this point. But CPI, on the other hand, there's a lot to that one. So the one thing about saying, it's one of those days where we could really move is it's not a unique perspective. I'm not the only one who's suggesting we could make a big move. And what happens is they'll go out and hedge the hell out of it so that if we do make a big move, they either don't get hurt and or make money from the move. And when they hedge the hell out of it, we don't get a move. Think about why the move happens, right? You're caught off sides, you're scrambling to readjust your portfolio, you're either dumping something or buying something to readjust and compensate. But if you are already concerned about a big move, you get insurance, you hedge up, you're already managed, you're not scrambling, you're not buying or selling or dumping or doing anything. And that's why we don't get the big move. So I'm not saying that we won't get a big move today. I am just saying, we very likely end up at the end of the day really close to where we started today with a whole lot of nothing after a whole lot of violence. Like a hamster on the wheel. We just go running around all over the place. And when we're done, we're right back where we started. Probably not a popular opinion, but I've seen people wreck their accounts thinking, oh, it's going to be one of these really big move days, and they go out and get some SPX options and we don't get a big move at all. You're stuck holding the bag. So don't do that. As you can see, there really isn't anything else. We do have the crude oil report today. Every Wednesday we get the crude report. And with crude leading the way in everything, every sector analysis, crude is on top, or energy is. At the bullish percent index, it's crude. 6-month sector review, crude. 3-month sector review, crude. 1 month, crude. There is a really big deal right now about the strategic petroleum reserves, which you can go to the EIA website and you can go to the government site. You can see exactly how much reserves we have, or how little we have. And that means they don't have the buffer that they normally have. It's a tool. And right now the tool can't be used. It's like having a cordless drill, but a dead battery. Got to recharge it. Well, they've got to refill their reserves. So we're looking at FX Street. It has the impact anticipation. So newer traders who don't quite know what all of the different economic events are and which ones they should be weary of and which ones that that don't really matter. They all matter. I didn't say that, right? Wink. This will at least give you a gauge on the anticipated impact. We do have the 30-year auction today, and just like yesterday with the 10-year, this is one that I pay particular attention to, me and the 30-year. So that's at 1 o'clock today. Definitely want to keep your eye on that. But really, it's all about CPI. The hurry up and wait that we've been in all week is very likely going to end. But I'm just going to continue to stress caution that just because the hurry up and wait is over doesn't necessarily mean we're going to go anywhere. But this market has been holding its breath for quite a while. The wall of worry over the last few weeks, and I think it's ready to just make a decision and go. It won't stay in wait mode forever. Tomorrow we have PPI and retail sales. We get some job numbers and business inventories. So, as big as today is, it's certainly not the only thing on the docket this week. We still have other things. (8:30, 10, 10:30, 1 o'clock, 2 o'clock. That treasury statement should be interesting. From the numbers that I was seeing, we're going to be getting some projections on, refilling the coffers and, outflows. Yeah, it's just not looking good. We'll see how it comes out. We'll know more by tomorrow what the numbers are. All right, so taking a look at the weekly, we're still holding above all of the major moving averages, the 50, the 20, the 10, and it doesn't even matter, which 10, the EMA, the SMA, which 20, both, it doesn't matter. We still have that call wall at 45.50. And if you're a little stuck on that, like, what's that mean? So imagine it like this. Say you've got 100,000 calls and you don't want them anymore. You're trying to get rid of them. And so every time they get into the money, you take them off the table, right? Take some profit off. So that call wall is where a massive amount of calls are at. And every time we get up into that 45-50 area, we're putting those calls in the money. And market makers and big traders who have pockets full of these calls are unloading the damn things. Well, when they go in selling them, it creates this ceiling or this cap, and price can't get through that area because they just keep selling there. It's not because they're trying to short the market or anything like that. They're just unloading what they're holding. So one way to gauge, are we done yet? Have we, kind of finished all that off? So we can just look at open interest. That's what places like Trady Ticks and Spot Gamma and things like that, where they show where the call wall is and the put wall. They're showing you where there's large amounts of open interest. Being able to answer that question, if we get up into that zone again, is there anybody still there? Yeah. Now, just because it's the largest place of open interest, it doesn't mean it can't be passed through, right? If those call holders really think we're going to get something out of this market, then maybe they won't sell it as soon as it gets into the money, right? They'll go ahead and hang on to it and see those calls get monetized a little bit. Maybe start getting up, a little closer to that 4,600 before they sell it. But we've been in this sideways nothing, and we still have to worry about where those open interest expire, because if they're running out of time, again, they're just gonna close them, right, when they get into the money. So that's what we're dealing with. We've got this thumb on the scale with a ceiling over our head at that 45-50. And we just can't seem to get through that zone. Now, if we were to take it over to the SPX, obviously the number would be a little different, but the shape of this would be the same. And that's why I kind of talk in a way that is S&P. It doesn't really matter if I'm on the ES or the NASDAQ or the SPY. It's the same shape. It's the same spot. Just fill in whatever number that happens to be. You can even do it on the Qs. Okay, don't you love that? So first time this week, we don't see the little liquidity issue button down there, right? The label isn't there today. Yay! But we're still light in the volume, and that's okay. We use this cumulative volume for a gauge, right? If we didn't know that there was something on the table today and we see the volume really light, then we could be concerned and we could go out and hunt for, hey, why is the volume light today? But we do know why it's light, because we do have econ on deck. So we really don't need that number this morning, and we could just take it off the board, get it out of the way. We have a market maker move today. We had one yesterday, but I'll argue that this thing is still broken. It's because of the contract change, and it's just sometimes tools don't work. So we should have a market maker move today because of CPI, and it might be there, but we can't tell because the tool is broken. I'm going to argue that there is a market maker move today, whether or not we can read it in its value or not. And judging from past CPI days, we're looking at about a 1% move on top of whatever our normal average daily range is, which happens to be a 1% move. And so we can just plot out a 2% move and say, that's easily what the market could do today. The S&P making a 2% move on the day. And that's nothing. The S&P's moved 5% in a day, so 2%, yeah, we can do that. We're not even talking extreme yet. The thing that makes it extreme is half the trading day is gone already. Yeah, I know that always throws people off. You just crawled your sleepy butt out of bed. So how can the trading day be half done? Well, it started last night at 6 o'clock and we're past 6 o'clock this morning. So half of the 24-hour cycle is already done. If SPY had started moving or the ES had started moving last night and had already made a 1% move, it wouldn't be hard to imagine we could make yet again 1 more percent and have a 2% move on the day. But that's not what we're talking about. We're talking about less than 12 hours, the S&P making a 2% move. Again, That's nothing. We've seen the S&P make a 2% move in 45 minutes. So it can do it. The thing is, again, the bigger we think the move is going to be, more likely the more it gets hedged, and we don't get that big move at all. We have an MDP at the moment. It's a missed daily pivot. We're underneath the 10-day, we're underneath the 20-day, and we're underneath the previous week's high. That makes sense. We can see that previous week's high here, 45.31. It's the cog line. So we're resting on top of all of the weekly moving averages, but we have the daily moving averages over our head. We did get inside day breakout through the overnight hours, but we did manage to come back inside again. Had a little bit of a move through the kill zone from 2 to 4, and it created a liquidity vacuum very similar to what we're focused on today as a CPI. Something came out, moved really fast, left unfinished business. So what did it do? It went back down and closed the gap. Same thing could be said way back here, that the market opened, they had an immediate reaction, which trapped people or had unfinished business, and we needed to go back there to close the gap. Now, the interesting thing about a CPI day or a PPI day or non-farm payrolls day is the unique nature of the move for us to get a trade. I got in here late this morning. I was going to have some examples already set up, but that's the way it goes. The dates are not hard to figure out. You can go to Google and you can type in CPI 2021, 22, 23. You can even get next year's CPI dates, I believe, already. And you can plot them out in advance. They tend to land around 11, 12, 13, and 14 on the calendar. So if you go, to August or January, February, March, 13, 14, 11, 12, somewhere around in there, that's generally where you find them. I should have let it finish. Thinkorswim is still trying to absorb everything that I asked it to do. We'll give it a little bit more time. See, that's not me moving Thinkorswim. That's Thinkorswim trying to give me every one of the days that I asked for it, and it's just still working. Once it quits moving, we'll know it's done. Speaking of, seems like it finally got done. Okay, so if you want to see what I'm looking at to tell what day it is, I'm looking right up here, right? That way I can see, what day is it? So as I move my mouse across, we can kind of get a feel for what day it is by looking up there. All right, so here's one of those days. It's not necessarily the best example, but it's one of those. And this is an example of what we don't want to see today if we're going to try to trade a liquidity close. The candle in focus is the 830 print, and it's got this really long wick on each side. It's not what we want. We want it to be a single direction with a non-stop push, just running up or down, it doesn't matter. And that creates the gap. This, if that's what we end up with, you'll just know that the entire strategy is done. Forget it. We didn't get a chance to do it, and we let it go and wait for the next time. No big deal. Let's take this back as far as we can go and see if we can find something other than June. All right, we got a May. There we go. I thought we still had one in range. So this is what we're looking for. That's a really great example. And the gap is where we were at 8:30. That's the gap that needs to be closed. So all the way down here. The news comes out, it makes this big push, and I know that that's what a lot of people want to trade, is that big push. I'm actually not expecting a 2% move up or down. No, that's what the expected move is though. All right, so expected move, it gives us a range. So the thing is, every market has a known move. We know exactly how far a candle should move. If you're on a 5-minute, a 5-day, a 5-year, a weekly chart, there's always a move. And the easiest way to kind of imagine that is just to imagine that there's this bubble around price, right? And when it closes and the new candle opens, that bubble is how far price should go, up or down. And then when that candle closes and we get a new candle, there is that bubble. Now, most charting software, in fact, all charting software, I've never seen one with a bubble. They won't offer you that bubble. They'll give you something like channels, Bollinger Bands, Keltner channels, acceleration bands, VWAP bands. Well, those are all variations of expected move. 1 standard deviation curves, 2 standard deviation curves. So it's still just telling you this is how far the market should go with a 70% with a 1 standard deviation, or a 95% with a 2 standard deviation. And so we know what a market should move on any time frame, on any market. And if we get a market maker move, then we add more to that. And we expand the bubble a little bit more, and we say this is how far a market could move if it's going to move normally. This isn't even blowout numbers, right? We're not even talking like shock and awe numbers. The S&P could move 2% today, and it wouldn't even be an outlier move. It would just be a shrug of the shoulders. Like, yeah, we moved 2%. That was about what we were expected to get. So the trade that I'm focused on today is a trade that we get a chance to trade 3 times a month. Maybe it shows up, maybe it doesn't. But if it does show up, it's a fantastic trade. I love this trade. Now, most people, when we get to this event, they try to trade the move. The report comes out, they jump into these big candles, and they try to hold on like riding a Bronco. And the only way you can do that is pretty much with a really wide stop, and you just got to close your eyes and hold your nose and jump in and hope you don't get stopped out, and hope you got the right direction. Hope is real, but it's not a great trade strategy, right? So I'd rather not trade the push. I'd rather come back and close the gap. All right. Now, maybe I cherry picked this picture, right? I just randomly happened to find the one example that showed the gap close. Maybe. But I don't think so. I showed you what it looks like when it fails, that it'll be these big wicks on each side, that there wasn't a single uniform direction in this push with one time framing. This is what we're looking for. With this trade, you have a lot more control. You can trade it with a much smaller stop. And, you know, could you still lose? Yeah, absolutely. When we consolidated across the top here, it really looked like they were considering just continuing the drive to the upside, and they could have. We didn't have to come down and close that gap. So there's no guarantee to anything, right? But out of every month that we've had this year, and the 4 opportunities that we've had to trade this, 3 out of the 4 worked. And even at the very least, if your bias says when we're getting these red candles that we're going to get that gap closed, you'll get a chance to trade to the short side somewhere in that whole move, knowing we're trying to get that gap closed. So it's not like you got to take the entire move. You could get some and then get out, and get some and get out. interestingly enough, when we do get the gap closed, what we have been getting is this extra leg right here to the downside as well. So it'll come down and it'll close the gap, and then it bounces up and it punches through to the other side for the exact measurement of this distance, which is interesting. I don't quite know what to do with it, but I thought I'd mention it because I've started to notice it. So again, none of this is guaranteed, right? Markets don't owe us this trade. And look at that. Go to the 0 line. I guess I measured the wrong one. It was this one that gets plotted to the downside. Didn't quite get there, but I didn't make it perfect either. So pretty interesting that we get that overshoot. I don't quite know what to do with it, but the gap close is back to here, right? And again, it doesn't have to go up. It can go down and then come back the other way. And it is a liquidity gap. You can see these liquidity gaps all over the place. It doesn't have to happen in Globex, and it doesn't have to happen in the futures. It can happen, in the middle of the day. Anytime you see the market make a very fast, very sudden, very extreme move away, and that's a liquidity gap, or that's what I consider a liquidity gap. And again, I've heard this called other things, right? This would be an example of a liquidity gap, that it very suddenly, shock and awe, just took off. And anybody who was trapped there or any unfinished business there, it wants to get back to that spot. And you can find varying degrees of that, right? It doesn't always have to be a really big candle. It can be a smaller candle. If you were to look up rally-based drop kind of scenarios, then it kind of gets into the same logic. They just don't talk about it as a liquidity gap. Either way, when we have CPI and PPI and non-farm payrolls, we have the potential for this trade 3 times a month. I love it. I love the opportunity for it, right? And if we don't get it, so what? There's next month. If we don't get one this week, it's no big deal. It's just one trade out of a lot of different strategies. And it can offer some fantastic plays. Plus, it's not like you got to do it in the futures. There's the Qs, SPY, options. So that's the focus today. We could go in and look at all the other stuff that's out there, but really it's all dependent on CPI today. If pot stocks are going to do good, if energy is going to do good, semiconductors, it's all going to come down to CPI. So there's really no reason to dig through the charts and try to get the Ouija board out and figure out what direction we're going to go or what's hot and what's gapped. And it doesn't matter. We need those CPI numbers. Now, it is possible that the numbers are a little muddy, right? And if the numbers are a little muddy, they're going to call timeout. They're going to get the nerds involved, and the nerds are going to crunch the numbers and then tell them what to go for. So, we could get an immediate reaction and then see a change in script, right? Just completely do the opposite. So the first move is not the move. And as you can see here, even though we did get that gap closed, we still went back up, right? It was still trying to follow through with that move that made us go up. I wasn't able to keep it, but there was some numbers, and I don't have them now, of how big the move was for the week following CPI. I'm sure if you Google it or check it, I'm pretty sure you can catch it on Google somewhere. There's an average move after CPI for a 1 week time frame or a 1 month time frame from one CPI to the next. How far did we move, kind of thing? And I'm pretty sure that that there's no real connection to, you know, how much it sticks. So we're going to get that volatility today either way, but it doesn't seem to be, you know, the driver for continued bullishness over the next month or continued bearishness over the next month. It doesn't seem to be like that. So that's just something to think about too, right? So we're not going to hit up on a bunch of different things because there's really no reason to. And if you're having issues with Thinkorswim's lagginess this week, they're porting over a lot of those retirement accounts, right? They're finally starting the integration with Schwab and TD Ameritrade, and it's really bogging down the system, bogging down the charts. So it's not your computer, it's not your internet, it's not your fault if you're having problems with Thinkorswim this week. The best you can do is complain. I know that might sound, you know, kind of petty, but if you complain, they might give you free commissions. And if you're trading futures on Thinkorswim, free commissions for a month or even for 2 weeks, you're talking about, you know, a couple $100. It wouldn't be the first time. They dropped the ball back in 2018 and really screwed the pooch. They were giving us commission-free trades for a month. And that's back when options were $5 a contract. So, yeah. You remember back in the day, paying $10, $15 wasn't much for the little trades back then. You'd pay more in commissions than you would make in profit. All right, everybody. We'll keep it short and sweet. Be careful, be safe. Remember this this gap close has hours to take effect, right? And that trying to trade between 8 and 9:30 is a dangerous proposition. You can let this thing make its move, start evaluating whether or not it's a good one. And even after 9:30, even 9:45 and into 10 o'clock, still have plenty of time to take that thing back to its gap close if the gap close is what we're going to get. Cool. I'll see y'all tomorrow.